Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Palantir stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 51 billion market cap. They're trading at $23 a share, and they have 2.2 billion shares outstanding. Their specialty is software platforms for big data analytics. They're known for three projects: Palantir Gotham, Palantir Apollo, and Palantir Foundry. They work a lot with the US government. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative free cash flow up through 2020. Positive in 2021, then it fell 43% in 2022. They had the highest ever, 700 million in 2023, up nearly 300% from 2022. They just completed their 2023 fiscal year, and they have really good margins. Free cash flow margin 31%. That means they convert 31% of their revenue into free cash flow. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that was negative in 2020, 2021, and 2022. It did improve a lot each year, but it was positive in 2023. 217 million. Their net profit margin is 10%. That means they convert 10% of their revenue into net income. Revenue is a sales for the company, and that looks pretty good. It doubles from 2020 to 2023. It grew a lot from 2020 to 2021, 41%. But it's only grown 24% in 2022, 17% in 2023. So their revenue growth is declining. We estimated 4 years of future free cash flows. We also estimated the terminal value of all cash flows past year 4, that's 47 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $38 billion. We divide that by 2.2 billion shares. And we get a calculated stock price of $17. They're trading at $23, so they're trading at a 32% premium. It's a sell according to the model. A lot of the stock price is not based off of what the company will actually do. It's based off of what investors think the company will do. And if they can convey their link to AI in a big way, then I think you might see a big run-up. But the stock hasn't done that great since they started trading. It has come up a lot since the bottom, but it's still a lot lower than its all-time high. There are 144 companies in the same industry as Palantir, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't need to spend much in CapEx. Most of their spend is in R&D. They have a really good debt-to-equity ratio. For every dollar of equity, they only have 10 cents of debt. They don't pay a dividend. Most companies in this industry do not pay a dividend. They are finally generating positive free cash flow. It is worse than the average, but a lot better than the median. They're the 8th largest company on this list. The largest company in the world is right here, Microsoft. Their price to book is a little better than the average, a lot worse than the median. They're trading at 233 times earnings. Only Block is worse. They're trading at 73 times free cash flow, a little worse than the average. And they're trading at 23 times revenue, about the average. They have a strong 5-year annual revenue growth rate, 30%. Zscaler is the highest at 52%. Let's go through their 10K. This is the income statement, 2021, 2022, and 2023. So revenue grows each year from 1.5 billion to 2.2 billion. Let's see if they give a breakdown of the 2.2 billion. They break down their revenue by government and commercial. Government went from 900 million to 1.1 billion and 1.2 billion. Commercial growth is more aggressive, 600 million to 800 million to 1 billion. So government revenue is about 60%. Here's a breakdown of their revenue by location. 1.4 billion in the US, that goes up each year. 235 million in the UK, that also goes up each year. Rest of the world, 600 million. So the percent of revenue in the US is at its highest point, 62% of its revenue. In the UK, it was 12% last year. Now it's 11% this year. And revenue in the rest of the world is declining. It was 32%, now it's 27%. All the expenses directly tied to generating a revenue of $430 million. So their gross profit looks really good, $1.8 billion. Here's a breakdown of the expenses. Sales and marketing, $745 million. R&D, $400 million. G&A is down. It goes down each year from $611 million to $600 million to $520 million. Their operating expenses are up a little bit from prior years. So they finally have positive operating income for the first time, $120 million. Really big improvements year after year, from negative $400 million to positive $120 million. They received $130 million of interest on their investments. They paid $3.5 million of interest on their debt. In other income and expenses, they had a loss of $12 million. So their net income is $217 million. EPS of 10 cents. They are adding shares. They went from 1.9 billion to a little under 2.1 billion to a little over 2.1 billion. Let's take a look at their balance sheet. Current assets of 4.1 billion. Current liabilities of 750 million. So a really high current ratio. It's above a 5. That means they can cover their current liabilities with their current assets more than 5 times. 3.3 billion of cash and marketable securities. Accounts receivables, how much they sell on credit, 360 million. And prepaid expenses, 100 million. Total assets, 4.5 billion, 1 billion more than last year. That's because they have 1 billion more of cash and marketable securities, 2.5 billion to 3.5 billion. Total liabilities, 1 billion. Deferred revenue is their biggest liability. This is when a customer makes an advance payment for a product or service that they're going to receive in the future. So it's carried on the balance sheet as a liability, and when they provide the service, they remove the liability and book it as income on the income statement. They also have 200 million of customer deposits. That's similar. That means the customer prepaid for something, and when Palantir delivers the product or service, then they remove the liability and book it as income. So a pretty solid balance sheet. They raised 9 billion from selling their business. They lost 6 billion from running their business. Let's take a look at the statement of cash flows. So they do have positive operating cash flow each year. Their highest ever at over 700 million. The way you calculate operating cash flow, you start with net income of 217 million. You add back depreciation and amortization, 33 million. You add back all the non-cash expenses on the income statement. The biggest one is stock-based compensation, nearly $500 million. Then you adjust for changes in working capital. They had a cash outflow of 100 million when they extended credit to their customers. So if they sold a product or service on credit, meaning they use accounts receivables, that's a cash outflow in this accounting period. But when they get paid by the customer, it'll be a cash inflow in that accounting period. They spent only 15 million on PP&E. These big numbers are the purchase and sale of marketable securities. They also received 51 million from the sale of alternative investments. I wonder what that is. And they received 218 million from people exercising common stock options. So cash at the beginning of the accounting period, 2.6 billion. At the end, 850 million. Let's take a look at the stock on Simply Wall Street. Its last price, 51 billion market cap, down 6% in the past week, up a lot in the past year, 184%. Let's see what they say about the company. Palantir builds and deploys software platforms for the intelligence community to assist in counterterrorism investigations and operations in the US, the UK, and internationally. They provide Palantir Gotham, a software platform which enables users to identify patterns hidden deep within datasets, ranging from signals, intelligence sources, to reports from confidential informants, as well as facilitates the handoff between analysts and operational users, helping operators plan and execute real-world responses to threats that have been identified within the platform. It also offers Palantir Foundry, a platform that transforms the way organizations operate by creating a central operating system for their data, and allows individual users to integrate and analyze the data they need in one place. They also provide Palantir Apollo, a software that delivers software and updates across the business, as well as enables customers to deploy their software virtually in any environment. Also, Palantir Artificial Intelligence Platform that provides unified access to open source, self-hosted, and commercial large language models that can transform structured and unstructured data into LLM understandable objects and can turn organizations' actions and processes into tools for humans and LLM-driven agents. LLM is commercial large language models. They were incorporated 21 years ago and in 2003, headquartered in Denver, Colorado. They IPO'd at the end of 2020 at about $10. They peaked at $36 about 3 months after IPO. And then they bottomed out at the end of 2022 at $635. They've had a nice run up since that bottom, up about 300%. Simply Wall Street values them at $37. They say the stock is 38% undervalued. 16 analysts priced this stock at $19. They say the stock is 19% overvalued. Their revenue target for 2024 is $2.7 billion, 2025 $3.2 billion, 2026 $3.9 billion. Look how much their free cash flow is projected to grow. $860 million in 2024, $1 billion in 2025, $1.7 billion in 2026. They did have some debt in 2019, $400 million. Many companies use the proceeds from an IPO to pay down debt. Now they're debt free. And you can see their equity is strong. It goes up a lot each year. But it's not going up because they're profitable. It's going up because they raise capital. You can see the green line is their cash. They just started becoming profitable this year. The CEO's salary went up from $900,000 to $1.1 million. Total compensation $5.5 million. Tenure as CEO 21 years from the beginning. Half the company is owned by the general public, 40% by institutions and 10% by insiders. Vanguard is the biggest shareholder at 9%. Peter Thiel, the founder of PayPal, owns 7%, then BlackRock, then the CEO. Then you see Morgan Stanley, UBS, famous investor Stephen Cohen, Kathy Wood's ARK, the investment management company SquarePoint, 0.28%. A good sign is seeing employee count increasing. It was 2,400 in 2019. It's at 3,700. The ticker trades on the Wiener Börse, London Stock Exchange, New York Stock Exchange, Deutsche Börse, Zicha, Mexican Bolsa, Bulgaria, BATS Europe, and Sao Paulo Bolsa. Let's take a look at some of their recent news articles. The CEO and co-founder Alex Karp intends to sell 650,000 shares in the next 90 days. That'll give him a cool $16 million. And that's a really small part of his portfolio. He has over 55 million shares. In the past year, insiders have sold 200 million more than they bought using options and regular market transactions. That's in the last 12 months. Their 2023 earnings exceeds analyst expectations. EPS of almost 10 cents. That's of course up from last year because they had a loss last year of 18 cents. Revenue up 17% to $2.2 billion. Their margins are improving a lot. Net profit margin of 9.4%. They're finally profitable. Revenue was in line with analyst estimates. EPS surpassed analyst estimates. And their revenue is forecasted to grow 16%. That's an average over the next 3 years. That's compared to a 13% growth forecast for the software industry as a whole. Here's a Seeking Alpha article about Palantir becoming part of the S&P 500. I think that's pretty unlikely. But they did have 4 straight quarters of operating profit, which of course increases their chance of joining the S&P 500. And this article says the company's focus on healthcare contracts could be a key driver to becoming part of the S&P 500. Seeking Alpha says they're a strong buy due to their revenue growth, operational profitability, and revenue diversification. Here's an analyst article, Palantir Q4, fulfilling promises, but I am downgrading this stock. They recently reported their 5th consecutive GAAP profitable quarter. In addition to remaining debt-free, the company's cash pile is helping it generate substantial interest income. We saw that when we looked at the income statement earlier. Half their net profit is interest income. Relatively slower growth in the government sector is a concern to be tracked, as is a 12% increase in shares outstanding since 2021. They are diluting shareholders. This article is written by the company TradeVestor, and they say they are downgrading the stock to a hold even though it gained 200% in the last year. Another insider intends to sell 120,000 shares in the next 90 days. That will give him $2 million in cash. 120,000 shares is about 36% of his holdings. On February 6th, here's an article about share price stability. Their share price has been volatile over the last 3 months. It's more volatile than 75% of American stocks, typically moving 11% a week. This is considered a minor risk. Share price volatility indicates a stock is highly sensitive to market conditions or economic conditions rather than being sensitive to its own business performance, which may also be inconsistent. It also increases the risk of potential losses in the short term, as a stock tends to have larger drops in price more frequently than other stocks. They mention dilution again. Shareholders have been diluted in the past year. 4.6% increase in shares outstanding. Back on February 6th, an analyst said their price target is $17.63. When this article was written, the stock price was $22. It's currently $23. Here's an article on February 5th. Palantir stock pops on unwarranted optimism. Avoid. After reporting a relatively small top-line beat, Palantir stock is jumping 17% in the after-hours session. Stronger than expected commercial revenues reflect positively on AIP. That's their artificial intelligence platform. Their current growth rate and 2024 growth outlook of 20% year over year is nothing extraordinary. I agree, 20% is nothing extraordinary. If their revenue was $100 billion, 20% is extraordinary. But their revenue is so low, they should be jumping like 50, 60%. Despite a decent Q4 showing, their stock looks overvalued with potential downside of 33%. This article is from 128. Palantir, still misunderstood, disproving bear arguments. Their stock-based compensation is under control and approaching industry standards. They did have high SBC when we looked at the statement of cash flows earlier. It was like $500 million. The company's investments in SPACs have provided valuable frontline R&D and outsized revenue contracts. Concentration risk is misunderstood. Instead, it's a safety net for Palantir, where the top 20 clients show strong retention rates. Palantir stock is undervalued. There's a realistic path for Palantir to retain a position as an AI industry leader and scale growth with the AI market. The title of this article is Palantir Technologies Share Price Matching Investor Opinion. You may think a price-to-sales ratio of 16.9 is a stock to avoid. Almost half of all software companies in the US have a price-to-sales under 4.5. And even price of sales lower than 1.9 aren't out of the ordinary. However, the price of sales might be quite high for a reason, and it requires further investigation to determine if it's justified. They've been doing a good job lately, growing revenue more than competitors. The price to sales is high because investors think this strong revenue performance will continue. If not, then existing shareholders might be a little nervous about the viability of the share price. Last year, they grew revenue 16%. Over 3 years, revenue is up 113%. The next 3 years should generate revenue growth of 25% per annum. That's estimated by analysts. That should be materially higher than the 17% forecast for the broader industry. Our look into Palantir shows that the price to sales ratio remains high on the merit of its strong future revenues. At this stage, investors feel the potential for a pullback in revenue is quite remote. justifying the elevated price-sales ratio. Unless these conditions change, they will continue to provide strong support to the share price. This article is from January 7th. Palantir, AI overhype warning. Palantir remains overhyped and lacks the actual growth metrics to justify its high valuation. Enterprise AI software companies are not seeing aggressive spending from corporations. I think they may have a point there. Despite the strong use cases and excitement for generative AI and LLMs. LLM are large language models, like for example, ChatGPT. The stock trades at 13 times 2024 sales targets, and even the Jefferies $13 price target is too aggressive to yield solid returns for investors. Isn't it fun going back and seeing how incorrect these people are? This is from December 16th. Palantir has the AI edge. Artificial intelligence platform has gained 300 customers in the 5 months since its launch. 300! That's a pretty small number of customers. Palantir's revenue growth guidance for 2023 is 4.25 to 4.44%. And it has earned a GAAP net profit for the last 4 consecutive quarters. Make that 5 because they also hit fourth quarter of 2023. This should translate to $529 million to $600 million in EBITDA for 2023, if their EBITDA margins remain consistent with Q3 2023. This article is from 12/8, Palantir, Insider Selling, and My Acid Test. Valuing high growth stocks is difficult due to limited historical data, lack of profit, and uncertain growth curves. Palantir PE ratios are meaningless, ranging from 69 to 250, depending on your interpretation of EPS. Because some people calculate EPS with stock-based compensation, others calculate it without. That's just one example. 2 methods are applied on Palantir for a more subjective assessment, a so-called acid test and its insider activities. Results from both methods raise concerns. This article is November 21. So 3 months ago. Palantir's NHS deal is all about optics. The UK's National Health Service has signed a landmark deal with Palantir to create its federated data platform. Revenue impact at 2.6% is respectable, but not spectacular. More important are the optics of Palantir as a trusted AI partner to manage an entire country's healthcare system. Saving lives is diametrically opposed to killing bad guys, which is what Palantir software has been known for, because they work with the US government on counterterrorism. Palantir wins in healthcare with Turbo Boost, the growth of its commercial business as it expands beyond national defense and intelligence use cases. Palantir is a hold due to recent price run-up, possibly as the result of NHS deal details being leaked. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.